What if I told you the next housing collapse wouldn't come from Wall Street, but from the Federal Reserve? All right, so listen, we're going to take a little history lesson today. So I'm going to take you back to 2008 and then I'm going to bring you forward. All right, so back in 2008, I know a lot of my listeners, some of y'all weren't even born then, some of y'all are like 3 years old, right? But anyway, we had a housing market crash. Essentially, what happened is banks started offering what we call ninja loans, right? NINGA. Now, it's not the ninja you thinking about, but this is no income, no job, no assets. So essentially, someone who was, let's say, a waiter, right? Waiters don't necessarily make $150,000, but they were putting them in loans for houses that could only be afforded by someone who was making around $150,000. So imagine you have someone making $35,000 a year. They shouldn't be in a 250 or $300,000 house. Why? Because the risk is really high, right? So what these companies started doing is they said, "Nah, we're not gonna stick to the plan." There's a great movie. I was just watching this. It's called The Last Week of the Lehman Brothers Crash. So if you want to do, some research and watch a movie, go check that one out. It's a really good movie. But anyway, they had these loans, right? And so the interest rate was really low at the time. And so people were able to get into these houses for, 2, 3, 4% loans. All right. Not that big of a deal. Some people were able to afford it longer, some people not so much. But they had what we call a balloon payment or a balloon interest rate on the back end of them. So after your 12, 16, 18, sometimes 24 months of payments, this thing would balloon to 8, 12, 14, sometimes 27%. So that means your house payment went from $800 a month to almost $3,500 a month. Now, if the person couldn't really afford the house in the first place, what do you think happened to those houses? Well, they got taken away, right? And so the people who had a lot of money came in and bought up those houses. Now that I kind of cut across the field with that, but it caused a entire shutdown of a real estate market that was booming before that, right? So people had some one, two, three, four houses, right? Then all of a sudden they couldn't afford these houses anymore. So it shut everything down. Now, why did I take you back and show you 2008? Well, the exact same playbook is playing out right now. So this administration has said several times, as a matter of fact, they literally just said it less than a week ago, we want interest rates down at 0%. Now, why would it make sense for them to have the interest rates down at 0%? Well, if we're resetting everything and we're going to run this same play that we ran in 2008, why not get interest rates down as close as possible to 0% so that when we run these ninja loans, they're at 2 or 3%. So people are going to do the exact same thing. Why? Because we've been taught if you live in America, you should own your own home. Now, that's true for some people in some places, but it's not necessarily true for everyone across our country. So they're going to run this play. And then once the interest rates bounce back up, because these are going to be ninja loans, so they're going to have balloon payments on the back end of them, the same people who are able to buy 4 and 5 houses in cash, those people that have been investing, those people that hopefully like you that have been listening to what I'm telling you, so you have some dry powder on the side, you're going to go back in, you're going to buy those houses once they get repoed, and then you're going to be able to rent those houses out to the very same people who couldn't afford to pay for them when they were mortgaged, but now they can afford to pay a rent. It's a cold-blooded game, y'all. I know you're probably sitting there like, "Why how is this legal?" Well, technically, it's not legal. But a lot of times what we've seen is lobbyists will go to Congress and they'll say, "Listen, we'll give you $1 million. We're going to run this same play from 2008, but when the hammer drops, we need you guys to, give us a little reprieve. Don't send us to prison." There's some stats that show that no CEOs from the last time this happened in 2008, zero CEOs. Now you had thousands of companies doing all of this. They were all entwined with this whole thing, right? Zero CEOs went to prison for this white collar crime, right? Now, if you go rob a bank and you take $2,000 out of there, You're going to go to prison. You're going to get a record. You're going to be a felon. You're going to serve 20 years. But if you go and you screw over the entire economy and take 17, 18, there was one guy made $33 million as a CEO. Go check it out. I'm not telling you something that's not untrue. Made $33 million on these deals. Guess where he is right now? Back on Wall Street as a CEO of another company that is in the same market. It's cold blooded. I know it's white collar crime, though. So, what are we going to do? So, listen, I want you to be prepared for this, right? So, first of all, I want you to think about something, right? So, President Trump is going to bring in whoever he wants to be his next Fed chair, right? Jerome Powell is out of here. He's essentially a lame duck at this point. He has maybe two more Fed meetings. He probably won't cut interest rates anymore. If he does, it's only going to be one cut, probably 25 basis points. All right. So when Trump brings in whoever he wants to be his next Fed chair, he's going to probably put the pressure on that person to move interest rates as close to zero as possible. Now, most people say, oh, that's pretty good because I can go out now and buy my vehicle or my car, whatever, my boat, whatever, at a really low interest rate. Well, in theory, yes, that sounds good. But of course, that hurts with inflation as well. So, this is what I want you to think about first of all. I want you to understand the rate cut cycles. So, lower rates equal cheaper borrowing. That's good for the short term, but it's not necessarily good for the long term. So, what does that mean for you? If you're in a position where you can go and get a HELOC on your house or something like that, now be careful with those. This is not financial advice. I'm just telling you some of the plays that I've run before when we had cheaper money, cheaper interest rates. So if you were able to take a HELOC out on your house, home equity line of credit, and maybe upgrade the house that you're in, that would be a smart thing to do while interest rates are lower. Why? Because you're borrowing at a lower rate, you're reinvesting it into the property that's already accrued some value, right? So hopefully you have some equity in your house. So at some point when you're ready to sell that home or maybe upgrade to another home and rent that house out, you've put some newer things into the house that would help with the resale value. That's one. Two, get out of cash before this cut occurs. Again, if the borrowing rate for money is lower, cash has a higher inflation rate. So we want to put our money into commodities like gold. You can look at silver. I'm a big crypto guy, right? So I really believe in Bitcoin. We've seen Bitcoin go from about 130,000 to down to around 84,000. So that's a big swing, right? Talking about $50,000 swing. However, it recovered a lot quicker than what we've seen happen with other commodities. So to me, Bitcoin is really a good storage. Ethereum, a really good storage. Texas Coin, a newer crypto that we have here specifically in Texas, a good storage for you as rate cuts occur. Leverage the cheap borrowing windows. Okay. So if you have some investment opportunities, if you can get into a rental property, if you can get a business, that would be a really good investment, right? If you were able to buy a business, if you were able to borrow money, buy a business, and get in that business while rates are cheap. And it's different when you take out a business loan versus, say, a mortgage loan, because normally you have what we call a fixed in interest throughout the life cycle of that money. Okay, so that's another way. Um, then you want to use volatility to your advantage. The markets swing up when interest rates go down because, again, people are using margin and different things like that to invest in the market. But you got to be very, very careful. You have to know what you're doing with that. I don't want you to go and just buy a bunch of stocks, right? I want you to look at the top stocks that are actually on the upswing in the market. I'll give you this one for free. This is my number one stock of 2026, and it's Netflix. Now, when I think about Netflix, I always think about how stupid I was because when Netflix IPO'd, initial public offering, when they first came out as a stock, they were around $4 a share, somewhere around there, right? And so instead of buying the stock, I knew better. I got the subscription. So I'm paying $7 a month. instead of going out and getting the stock. Recently, Netflix did a stock split. They did a 10-to-1 stock split. Netflix stock was up at $1,500 a share. So imagine if I told you, hey, give me $4 today, just one time, give me $4, and in 20 years, I'll give you $1,500 for every $4 you give me. Would you take that deal? Most people would take that deal, right? So I believe Netflix is a really good company for us to look at because their debt is really low right now. Now, this could potentially change, right? They're looking at buying Warner Brothers. So if they end up buying another company, they take on a lot of debt. It'll be a little different than what we saw with Disney a couple of years ago when they bought uh, Star Wars and all of them. I can't think of the company's name. Look it up. You'll see what I'm talking about. But again, Netflix is in the entertainment business. So they make their money off subscriptions. They make their money off of deals with like the NFL, which they signed that deal last year. And so I think this is a company that could burn through, they could burn their debt up really quickly and then be one of those growth companies that we look at over the next 10 or 15 years and say, yeah, it's at $93 right now, but it's at 27,000 in 10 years or 2,700, 2,700. Don't mark me on 27,000. But yeah, so those are the things that we're looking at with these Fed policy changes. So be very, very careful about these loans, guys. I don't want you to put yourself in a position where you're losing your house and having to move and do all of these kind of things. I know everybody wants a house, everybody wants a really nice car. But if it's not your time, then don't put yourself in that position. It'll add a lot of undue stress. All right. So listen, this is our website, qpwealthhub.com. We teach these kind of things every day. So we built out an entire platform that's specifically for the middle class to learn these financial investment tools that we're teaching here. So we'll see you on the next episode. Think you grow rich.